The so-called safest asset in the world has quietly destroyed almost half of its value in just 5 years. That's US Treasuries, the very bedrock of the financial system. Meanwhile, the US is adding $1 trillion of debt every 100 days. For context, that's faster than every war in US history combined. And here's the hard truth. The Fed literally cannot allow a recession to happen because it would detonate a $37 trillion debt bomb. So instead, they're trapped into printing forever. And that means the old system is dying while a new one is being built right underneath our feet. I've been obsessed with financial markets, and I've had the privilege to work with some of the greatest investors of all time. And what I'm seeing now is the biggest wealth transfer that is setting up in modern history. If you don't understand, you'll sit in cash and watch the smart money capture up the generational upside. Economists call it creative destruction. Treasuries, once the safest store of value, have already fallen. The replacement is already here. This isn't just another cycle. It's a 0 to 1 moment, like the invention of fire or the iPhone. Let's talk about this debt explosion. In 2000s, it took years to add $1 trillion of debt. And by 2010, it only took 1 year. And today, it takes 100 days. The parabolic curve is undeniable. But here's the fatal flaw. Treasuries, the bedrock asset, have lost 47% in just 5 years. So instead of safety, investors got completely wrecked. The traditional 60-40 portfolio is officially becoming obsolete. And we've seen this movie before. In 1971, Nixon closed the gold window and the world shifted overnight. In the 1990s, Kodak ignored the digital cameras and they died. When the bedrock fails, the new system doesn't wait, it takes over. We are now entering the Financial Refinery Model. Think of crude oil entering a refinery and producing gasoline, jet fuel, and plastics. Now replace oil with Bitcoin. Bitcoin goes in, multiple tailored financial products come out. This is not alchemy, it's the architect of finance. MicroStrategy pioneered this model. They've taken one input, Bitcoin, and refined it into 4 distinct products: stock, leveraged Bitcoin exposure, high upside and high volatility; Strike, 8% fixed dividend plus optional conversion to equity; Stride, 10% fixed income, senior secured; Stretch, stablecoin, like 9% yield, money markets alternative. Different flavors for different buyers: equity chasers, dividend seekers, conservative bond buyers, and cash parking corporates. Now let's look at a 5-year scorecard of all of these. So you have bonds, which is -4%, gold plus 10%, the S&P 14%, Mag 7 27%, Bitcoin 58%, MicroStrategy 100%. In 1 year, the pattern repeats. Refinery beats legacy. This is the iPhone moment, but for finance. Now imagine you're Warren Buffett. Berkshire Hathaway sitting on $340 billion of cash in treasuries, losing money every single day. Amazon, $98 billion, Google, $95 billion, Microsoft, $95 billion. Collectively, through it all, there's trillions of dollars that are bleeding. Now, what happens when those reserves rotate into refinery models? The flow would dwarf anything Bitcoin has ever done. Now, let's just talk about these addressable markets. Treasuries sitting at 28 trillion, you have 10 trillion in mortgage-backed, 5 trillion in corporate bonds, and 48 trillion in dividend stocks. There's hundreds of trillions and all underperforming inflation. Refinery products are still small, just billions, but they yield more with better collateral and integrate seamlessly. This is the digital cameras replacing film in real time. This shifts fit into a 50-year technology cycle that's repeated 6 times in 300 years. Now you have phase 1, which is the eruption. This is when Bitcoin was adopted by retail traders. And phase 2, which is the frenzy. This is where institutions and governments pile in. Now, if you overlay the S-curve, you'll see adoption is just hitting the steepest climb. If you think you're late, you're actually very early, and that sounds cliche to say because as a retail trader myself, and potentially you've heard this phrase over and over, but it's very true. Now, there is risks and objection handling. Yes, Bitcoin is volatile. Yes, regulations are evolving. Yes, products are new, but volatility is the toll you pay for an asymmetric upside. And institutions entering now are proving this model isn't just a fringe, it's the future. Now here's the playbook. Step 1, own the base layer. buy Bitcoin directly. Step 2, add refinery exposure. Equities in Bitcoin treasury companies. Step 3, if you run a business, redesign your treasury into a refinery. Turn idle cash into structured yield. That's how you front run the next wealth transfer. The $37 trillion trap guarantees the old system cannot be saved. The refinery model is the bridge to a new one. Don't sit in cash while wealth evaporates. Position before institutions lock the gates, because when reserves become revenue, the re-rating will be violent. And there's so many things investors could do now to take advantage of all of this upside, like looking at other alternatives from Bitcoin and all of its refineries, and the same things happening in technology. The way people invest and trade is becoming vastly different. For instance, in this channel, the refinery of trading is being substituted with trading algorithms that are based off logic and back-tested data that humans simply cannot quantify, which is why they embed these things into code to take trades for people. If you have no idea what I'm talking about, in this channel, I talk about algorithmic trading softwares and how they've impacted my portfolio. If you're interested to see how they've done, just click any of the videos and watch. Thanks for watching.